From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, March 2nd. Here are the top market stories we are following for you at this hour. War rages on. Ukraine says it may hold a second round of talks with Russia as the brutal invasion intensifies. President Biden uses his first State of the Union address to label Vladimir Putin a dictator as the EU looks to expand sanctions against Belarus. Commodities hit new highs. Supply shortage fears send wheat to the highest since 2008, aluminum to a record, and European natural gas prices to one too. Plus, oil jumps north of $110 a barrel as OPEC Plus stays the course looking through Russia risk. And Powell in the hot seat. The Fed chair will testify in the House this hour. He'll tell lawmakers he sees rate liftoff this month while geopolitics cloud the outlook. Traders that have priced out a 50 basis point hike this month will hang onto every word. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off. Welcome to Bloomberg Markets. And Guy, Chairman Powell going to speak any minute now. The backdrop, once again, geopolitics.
Absolutely, but he is making it very clear that at the moment the Fed is still on track to deliver rate hikes. That is something that we are going to be seeing very, very shortly. But he did lay out the fact that we live in a much more uncertain time. I think that's probably less of a problem for the Fed, more of a problem for the ECB right now. We've seen huge gyrations, obviously, in European government bonds. But yes, we will be listening to every word that Chair Powell has to say, not only today, but also tomorrow. Events are unfolding very, very quickly. Maybe we'll see a finessing of the speech day one to day two, but like Greenspan used to. But Katie, let's talk about, as you say, the situation in Ukraine. The country saying it may hold a second round of talks with Russia. This is the country's defense ministry said its forces have captured a Ukrainian Black Sea port north of Crimea. This is the Russian defense ministry, of course. Over in the United States, President Biden used his first State of the Union speech last night to warn President Putin of the high price he'd pay for invading Ukraine.
He badly miscalculated. He thought he could roll into Ukraine and the world would roll over. Instead, he met with a wall of strength he never anticipated or imagined. He met the Ukrainian people.
Bloomberg's Washington correspondent Anne-Marie Hordern joining us now from the White House. Anne-Marie, was this a speech that delivered on expectations? Was this a speech that delivered on the objective of unifying America?
It delivered in terms of unifying the chamber, Guy, when it comes to fighting a geopolitical foe. Obviously, that was Russia. The president at one point asked the chamber to stand in a show of solidarity for Ukrainians, and everyone stood up clapping and looking at weirdly the woman that stole the show, and that was the Ukrainian ambassador to the United States, Oksana Markarova. That is where the president really won that bipartisan support. But, Guy, that part of the speech was just a little bit less than 10 minutes. The remainder then really focused on his domestic issues. But one of those domestic issues has to do with the geopolitical crisis he's dealing with, which is the war in Ukraine and the premium that is putting on commodities across the board. You know, we talk a lot about oil and gas, but it's also wheat, it's corn, it's nickel, it's palladium, it's aluminum. All of this feeds into the inflation story.
Yeah, all feeds into higher prices for American consumers, Anne-Marie, and he went out of his way in his speech to say that he is taking great effort to make sure that the sanctions hurt the Russian economy, not the U.S. economy, saying that really price pressures are his number one focus. If that's the case, is that an indication that he's basically gone as far as he's going to go here?
It does sound like it, right? Because the administration has said that they have these so-called carve-outs for the energy sector. They want to make sure Russian crude stays on the market so that it doesn't hit consumers in America or Europe or around the world, but it hits the Russian economy, which right now, we should note, it is the longest stretch that the Russian-Moscow exchange has been closed since their financial crisis in 1998. The ruble has been in free fall, and if you look at what some of these banks are trading, like Sberbank in London, it's literally a penny or two. So it hitting the Russian economy. But the issue is individuals in the market players I'm talking to, people potentially do not want to touch or not know when they should touch. Can they touch Russian crude? And you can see that for Russian oil, Urals. It was down as much as almost $20 to the Brent benchmark, and still individuals don't want to pick it up. If you go there to pick up Russian crude on the shipping, it's about 300% more. Refiners don't want to touch it either. Potentially, this is also not just about the fact that they're not sure about how they're going to make those transactions of trade, but also from a moral standpoint. What does this mean for their reputation?
Reputational risk, financial risk, maybe some self-sanctioning going on across the board. Thank you so much to Bloomberg's Anne-Marie Horton at the White House for us. Now, of course, elsewhere in Washington, D.C., over on Capitol Hill, we are awaiting Fed Chair Jay Powell's semi-annual testimony before the House Financial Services Committee. You are looking at a live shot of that hearing. Committee Chairman Maxine Waters is giving the opening remarks. We're joined now by Bloomberg's international economic and policy correspondent Michael McKee, as well as Amy Wu Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. Mike, if we could just start with you. We've already gotten Chairman Powell's opening statement. He talks about a strong labor market. He talks about that he sees liftoff this month, even if Ukraine and geopolitics is clouding the outlook. Does he sound hawkish to you?
No, he sounds, well, it's all relative, I guess, Kaylee, is the way I would put it. He sounds relatively hawkish for where he had been, but compared to some other members of the Open Market Committee, he's still to the dovish side, at least in his prepared remarks. He comes out and he says, with inflation well above the 2% target and a strong labor market, we expect it will be appropriate to raise the target rate for the federal funds rate at our meeting later this month. But he doesn't say by how much he would raise it. Now, Jim Bullard, who's a voting member of the committee, the St. Louis Fed Bank president, said just a short time ago in a speech he's making that he still sees urgency and the Fed still needs to go 50 basis points. So they're clearly not united at this point, and there'll be a lot to talk about at the May 15-16 meeting.
A lot of uncertainty to factor in to their thinking, Mike. Amy, let's talk about that uncertainty. Chair Powell referencing it. The market hates it. Uncertainty incredibly difficult to deal with. It's not risk. It's not quantifiable. Amy, how good is the market at hedging geopolitical risk?
I would say the market is terrible. You know, prior to this geopolitical risk being on the table, the options market was actually doing a fairly decent job of pricing where they thought, you know, the Fed dot plots would be. Essentially, option investors now have said, you know, we have no idea what is going to happen in March in the context of what's happening in Ukraine. Essentially, people are taking any hedges that are new and they're throwing them all into May and June. They're basically saying, look, this is going to be highly uncertain for a long period of time. We don't know what happens in March anymore, so we're going to go down the line and just say that uncertainty continues for the next few months.
Okay, so they're pushing out their hedges. How expensive are those hedges, Amy?
You know, when you look on a percentile basis, you know, 3 years, 1 year, 5 year, what have you, they're all at historical highs. So sometimes it's important to compare them to other markets. And what I will tell you is, if you look to the fixed income market, you know, the volatility levels are hitting essentially the March 2020 peaks. And we are nowhere near that in the equity volatility markets. So, you know, we have a 33 on the VIX or so. But VIX hit 80 back in March of 2020. So I actually think that equity volatility still has a long way to go up, despite how everything looks pricey, you know, on those percentiles.
Mike, the Fed has retreated from forward guidance over the last few months. It is much more opaque now in terms of the guidance that it's providing. We have, as you just laid out, little clarity over whether we get a 25 or a 50 basis point hike. Given the fact that we have this geopolitical uncertainty right now, do you think the Fed is going to want to be a little bit more careful in terms of the guidance that it provides, maybe providing a little more clarity on the path that it sees rates being on?
Well, I think you got both points right, but in the opposite order. The Fed is going to want to have as much choice optionality as it can possibly get. So Powell will try probably to not let anybody pin him down about what they're going to do and how often they're going to raise rates. But they don't want to raise rates too quickly. They may not need to. Interesting comment from Jim Bullard just a few seconds ago saying that the market is going to price the Ukraine risk for the Fed because they're going to have their finger on what kind of damage it's going to do. And obviously the markets are pricing Europe in a lot worse shape than the U.S. at the moment.
Yeah, and Jim Bullard going on to say there could be a reordering of the global oil market. Mike, you were talking about how we're all focused on the hikes, whether they move 25 or 50 basis points, how many times they move this year. What about the balance sheet? How is that maybe adjusted in relation to some of the uncertainties that they're faced with?
They probably haven't changed their views on that at all. The problem for the balance sheet reduction is the Fed doesn't have a good mathematical model of what the impact of a falling balance sheet is on financial markets in terms of what does it mean compared to raising or lowering interest rates. So they do want to raise rates first. That'll be their primary tool. They know the balance sheet has to come down, so they will start lowering it. But they don't look at shrinking the balance sheet as a particular tool of monetary policy, more of a right sizing that they'll know they get there when the market starts to react as it did in 2018.
Amy, do you see any sign of stress in the system right now? Is this a market that is functioning properly? There have been some concerns, particularly about the funding markets, but from what you see in front of you, is this a relatively normal situation that we find ourselves with from a market perspective, obviously not from a geopolitical perspective?
Yeah, as far as the equity options market goes, it's still functioning in an orderly way. I think the liquidity on kind of the rates volatility side is very different right now. And, look, this is a little morbid to think about, but when you think about the real tail risk that is in the equity market right now, what is it? It's nuclear war, right? There's simply no way for the equity options market to price that, because the reality is if that happens, there is no equity options market to price, right? So in some ways, the equity options market has to be more sanguine, and you see that in kind of the normal functioning of both volatility as well as options volume.
On kind of the subject of liquidity, obviously the abundance of it is what fueled a lot of the retail activity we've seen really over the last 2 years. A lot of that had been buying bullish call options. Now we're starting to see them actually in quite force pursuing put options. That's pointed out by Jason Gopfert over at Sundial Research. How does the retail trader influence what these markets are doing right now?
Yeah, it's interesting because after 2 years of, buying out of the money call options and YOLO and meme stocks or what have you, that sentiment really has shifted, hasn't it? And I would say, it's not just retail. Institutions are also buying puts to a large degree. So, one technical aspect that we have to continue to watch in the options market is what happens when that hedge monetization occurs. So meaning when the hedges close, you actually can get support to the market. This is actually what happened last week between Wednesday and Thursday. There was a great amount of hedges actually being closed, which forces the dealers to essentially cover the shorts that they had on, which provided a little bit of that turnaround we saw to the market last week. Now, normally we would say retail, who cares that, they're a small portion of the market. We've learned in the last 2 years that's not true. They can have significant impact. So when you see that snowball onto institutional trades, you better watch for those changes in support and gamma as well.
Amy, what's happening with single stocks right now in terms of the moves that we're seeing? Do you have any visibility? There are a bunch of stocks that are directly affected by what is happening here. Some of them are in Europe, some of them are in the United States. Obviously, anything with Russia exposure is being whipsawed right now. What are you seeing in some of those single names?
It's interesting. We actually had a conversation about this with our team this morning, which is there's just very little appetite from investors and clients to listen to anything about single stocks right now, even if they are directly related, like an energy name. It's a very macro world, and when it's kind of geopolitical headlines all the time, the reality is correlations go very close to 1. So, a lot of the activity right now is macro. It's your proxy ETFs, it's your indices, and even if there are earnings coming, people aren't as focused on those single stock names. However, I think that, as these continued announcements come for these ESG related sanctions or, companies basically choosing to do things related to Russia, I think you're starting to see that divergence again as the news flow happens.
Mike, Amy talking about the macro picture. Let's talk about that macroeconomic picture and the data that the Fed is looking at and says it will continue to be dependent on. Jobs Day on Friday, CPI next week. How much could what Powell says today actually not truly reflect what the move they make in 2 weeks from now is going to be, because they haven't seen that data yet?
I think they know pretty well what the data are going to look like. In general terms, we know that inflation is high, and everybody's forecast is for it to go up in the next CPI. So the Fed's going to be looking at that, not so much for what the headline number is, but for what the composition of it is and whether it represents the Fed's view, as expressed by Powell in his opening statement, that they think as the economy starts to reopen, the prices will go down.
Talking of that opening statement, we are kicking things off on Capitol Hill. Thanks to Mike McKee and Amy Wu-Silverman of RBC Capital Markets. Let's listen to Fed Chair Jay Powell delivering his semi-annual testimony before the House Financial Services Committee.
We pursue these goals based solely on data and objective analysis, and we're committed to doing so in a clear and transparent manner so that the American people and their representatives in Congress understand our policy actions and can hold us accountable. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but with cases having declined sharply since mid-January, the slowdown seems to have been brief. The labor market is extremely tight. Payroll employment rose by 6.7 million in 2021, and job gains were again robust in January. The unemployment rate declined substantially over the past year and stood at 4% in January, reaching the median of FOMC participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has ticked up, labor supply remains subdued. As a result, employers are having difficulties filling job openings. An unprecedented number of workers are quitting to take new jobs, and wages are rising at their fastest pace in many years. Inflation increased sharply last year and is now running well above our longer-run objective of 2%. Demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus, and price increases are now spreading to a broader range of goods and services. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. The committee will continue to monitor incoming economic data and will adjust the stance of monetary policy as appropriate to manage risks that could impede the attainment of its goals. The committee's assessments will take into account a wide range of information, including labor market conditions, inflation pressures and inflation expectations, and financial and international developments. We continue to expect inflation to decline over the course of the year as supply constraints ease and demand moderates, because of the waning effects of fiscal support and the removal of monetary policy accommodation. But we are attentive to the risks of potential further upward pressure on inflation expectations and inflation itself from a number of factors. We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched, while promoting a sustainable expansion and a strong labor market. Our monetary policy has been adapting to the evolving economic environment, and it will continue to do so. We've phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month. The process of removing policy accommodation in current circumstances will involve both increases in the target range of the federal funds rate and reduction in the size of the Fed's balance sheet. As the FOMC noted in January, the Fed funds rate is our primary means of adjusting the stance of monetary policy. Reducing our balance sheet will commence after the process of raising interest rates has begun and will proceed in a predictable manner, primarily through adjustments to reinvestments. The near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war with sanctions, and of events yet to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. Maintaining the trust and confidence of the public is essential to our work. Last month, we finalized a comprehensive set of new ethics rules to substantially strengthen the investment restrictions on senior Federal Reserve officials. These new rules will guard against even the appearance of any conflict of interest. They are tough and best in class in government here and around the world. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Chair Pro Tempore Powell, as you know, the Fed is required to conduct monetary policy in a manner that fulfills its dual mandate to promote maximum employment and stable prices. But as you have explained, most of the inflation we're experiencing right now can be traced back to supply chain issues related to the pandemic, and the Fed cannot directly affect supply side conditions. These supply chain constraints seem likely to only significantly increase as Russia invades Ukraine, and the full effect of our sanctions take hold. If the Fed's tools are mostly useful in stimulating or constraining demand, how can we expect monetary policy to rein in inflation that is largely driven by supply-side factors?
Our policies really cannot, as you point out, affect supply-side conditions. Our policies affect demand. What we're facing now is, though, an elevated level of demand in the face of supply-side constraints, and it's the collision of those two things that's creating inflation. So there is an important job for us to move away from these very highly stimulative monetary policy settings to a more normal level of rates and perhaps tighter at a time when inflation is highly elevated, and that is what the committee plans to do.
So it seems clear that the Fed has limited tools to address inflation and that Congress has an important role to play. The Monetary Policy Report notes major shortages in housing supply as a factor in high prices. If Congress were to make investments to alleviate these shortages, do you think this would be helpful in addressing inflation?
Major investments in housing supply? So I think housing prices are high for a number of reasons, actually. Difficulty in getting lots, materials, difficulty in finding workers, very high demand. It's been extraordinarily high. So those are many of the features, and also low interest rates have made credit widely available. Mortgage rates are going up. That will probably begin to cool off demand. I wouldn't want to comment on congressional legislation, but I do think there's no doubt a role for Congress.
So I suppose I could conclude without having you comment directly on fiscal policy, that you agree there are ways to manage inflation outside of monetary policy. It's not only monetary policy, that others have a role to play.
I do think that's right, but more in a sort of medium or longer term sense. I think the Fed does monetary policy, and inflation is largely a monetary phenomenon, and it's our tools that can be used to address inflation. Over time, though, of course, anything that expands the productive capacity of the United States over time would, in principle, make greater potential output and a less constraining economy.
Fed forecasters expect that inflation will subside as supply chain disruption issues are resolved. However, housing and rent prices, as you've said, account for roughly 1/3 of the consumer price index, and most economists do not expect the problem to be resolved as quickly as supply chain bottlenecks due to both the time it takes to develop housing and the lack of investment in housing that is affordable to low and moderate income families. Currently, there's a shortage of nearly 7 million rental homes that are affordable and available to America's lowest income renters, and a shortage of more than 5 million homes for potential home buyers. In my district, there's a shortage of more than 34,000 rental homes that are affordable and available to the lowest income families, while the state of California has a shortage of more than 962,000 affordable rental homes. If Congress does not make the investments to increase supply and access to the affordable homes in this country, how concerned are you that the Fed will not be able to contain inflation?
Well, you're right that housing inflation is a significant part of the CPI. We also look more prominently at personal consumption, PCE, which is a different measure, and it's something less than that. And unlike these temporary supply-side constraints that we see, housing inflation really is much more of an indicator of the tightness of the economy rather than supply-side problems. So it's something we watch carefully, along with wages, frankly, and it is a major contributor to inflation. As I mentioned, higher interest rates housing is a very interest-sensitive sector, and higher interest rates, really interest rates that move back toward a more normal level, should act to cool off the housing market over time.
Thank you. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Chairman Powell, thank you for your leadership in tumultuous times, and this is certainly interesting times internationally, challenged times internationally. Everyone else on the Open Market Committee, it seems, has opined about the March meeting. Everyone. Whether it's a tweet or an interview or anything else. What are your thoughts going into the March meeting?
The March meeting. Okay, so here's how I'm thinking about the March meeting. And I guess I would start, of course, with the U.S. economy, which is very strong, the labor market extremely tight, and inflation running well above target. The way we think about our work is we develop working plans for making adjustments to monetary policy over the course of the coming months, and then we are flexible as plans meet the real world. So we're never on autopilot, obviously, and at a time like this, what we aim to do is lay out our principles, and then with whatever clarity we do have, and then proceed to implement those policies carefully and nimbly. So coming into this meeting, let's say before the Ukraine invasion, the committee was set to raise our policy rate, the first of what was to be a series of raises expected for this year. Every meeting was live. Decisions would be based on incoming data and the evolving outlook. I also expected we'd make great progress on our plan to begin to shrink the balance sheet. And so the question now really is how the invasion of Ukraine, the ongoing war, the response from nations around the world, including sanctions, may have changed that expectation. And so it's too soon to say for sure, but for now I would say that we will proceed carefully along the lines of that plan. The thing is, the economic effects of these events are highly uncertain. So far, we've seen energy prices move up further, and those increases will move through the economy and push up headline inflation, and also they're going to weigh on spending. We're seeing effects on other commodities, and perhaps from declining risk sentiment and weaker growth abroad. The thing is, we can't know how large or persistent those effects will be. That simply depends on events to come. So this is where that leaves me. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. We're also going to write down our new summary of economic projection, individual forecasts, which will show each participant's views of the path forward in the economy and with rates. I also expect that at this meeting we'll make good progress toward an agreement on a plan to shrink the balance sheet. We will not finalize that plan at this meeting. We'll do that when we think the time is right at a coming meeting. The bottom line, is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy. We use our tools to support financial stability and macroeconomic stability. We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. So that's how I would think about it.
Very specific. Now, you mentioned 25 basis points. From all the analysis about what the Fed will do over the course of the next year, is 25 basis points the floor, the ceiling? Is it the speed limit? Is that the max you think the Fed could take on? How do you think of that?
So here's how I think about that. We have an expectation, those of us on the committee have an expectation that inflation will peak and begin to come down this year. And to the extent inflation comes in higher or is more persistently high than that, then we would be prepared to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings.
Now, you mentioned the balance sheet, a plan for the balance sheet, and that is to come. But what I'm hearing clearly from you is that the Fed is very interested in financial stability given what's happening, and you're willing to make quick decisions on a question of liquidity, on a question of market stability, those important works that you've focused on as Fed chair. And so it's actually substantial news for the House to be the first rather than the Senate to break news. So thank you for your forthcoming, being so forthright about your views on this. And with that, Madam Chair, I yield back.
Thank you. The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Madam Chair, and thank you for ranking member for holding this hearing. Chairman Powell, thank you very much for being with us here once again. As we look at the unprovoked criminal Russian invasion of Ukraine, one of the most notable national security responses has been the President's recent announcement to cut off much of the Russian financial sector from SWIFT financial services. Our EU partners have also joined us and excluded 7 Russian banks from SWIFT. Chairman Powell, what practical effect would this have on Russia, its economy, its financial sector, and its people?
So thank you. I should point out that the Fed does not impose sanctions on other countries, that we, in this process of developing sanctions, we are not a principal. That's really a job for the administration, particularly the Treasury Department. So we provide technical background support and things like that. But I think questions about sanctions and their effects generally would be more for the administration and the Treasury Secretary. I think you can see, I will just add, though, that the effects of the sanctions so far appear, for now, to have been significant.
Yeah, I mean, we saw what happened to the ruble. We saw what happened to their market. The market's still closed. Is a way around it for them cryptocurrency? Could you talk a little bit about that? I know it's a little bit out of your bailiwick, but as you said, it's an interesting moment in time. You know, we haven't had to face this since really World War II, and even all the comments that you made about inflation and watching the market, so much of it is tied to obviously what the Russians are doing with respect to their unwarranted and criminal act there in Ukraine.
So I don't have any private information on the extent to which that is happening, but that is something you read about and hear about. And I just think it underscores the need really for congressional action on digital finance, including cryptocurrencies. We have this burgeoning industry which has many parts to it. And there isn't in place the kind of regulatory framework that needs to be there. It was probably no different with railroads or telephones or the internet. And ultimately, what's needed is a framework, and in particular, ways to prevent these unbacked cryptocurrencies from serving as a vehicle for terrorist finance and just general criminal behavior, tax avoidance and the like. So I guess that's what I would say there. I don't really know the extent to which it's happening, although you do hear that and read it in the paper.
Seems like an outform, since we did go down this road Could you comment a little bit about then the central bank digital currency? It seems like that would be something that would be helpful in situations like this.
Yes, so we issued a paper after much thought and many drafts. We issued a paper, was it late last year? I guess it was late last year, seeking public comment on the costs and benefits of a potential central bank digital currency issued by the Federal Reserve here in the United States, digital dollars. And we await, I think we gave an extended comment period, and we gave, and we very much look forward to reading those comments. This will be something that we invest a fair amount of time and expertise and in hiring people and things like that to try to get it right, but also to understand whether the benefits actually outweigh the costs, which I think is an unanswered question both here and around the world. Nonetheless, it's our obligation to move vigorously to understand the answers to that question so that we can deploy a central bank digital currency if it's appropriate. So would it, in principle, it depends on why people are using unbacked digital currencies. If they're using them to evade, visibility and evade the law, then for us just to have a law-abiding CBDC won't change that. They'll still be able to use those currencies for that matter. The existing digital currencies that again are not backed are really vehicles for speculation. They're not used in payments. They're not a store of value. They're speculation like gold. That's what they're used for. Whereas, potentially a U.S. CBDC would have a wider view. I do want to stress we have not decided to do it, but we do understand our obligation is to really get to the bottom and understand both the technical and the policy issues that need to be answered.
Thank you, and I know my time's about up. I just say from your lips to God's ears, I hope that the inflation does peak this year and does come down because people are hurting. And thank you very much again for your steady stewardship.
Thank you very much.
We appreciate it.
Thank you.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
We've been listening to Fed Chair Jay Powell's testimony before the House Financial Services Committee. Of course, the big headlines out of that so far, Chairman Powell saying that he is inclined to support a 25 basis point rate hike this March, providing some transparency and maybe clarity to a market that was looking for clues on whether that move would be 25 or 50 basis points. Powell did, though, however, leave a potential 50 basis point move on the table at some point if inflation continues to come in hot, though he says that the Fed still expects inflation to peak and come down this year, again expressing support for a 25 basis point move this March. As for how that's translating into the market reaction, we are seeing equities in and around the highs of the session. The S&P 500 at the moment up a little more than 1%, but the bond market, of course, really where you see a lot of that reaction, specifically at the short end, which of course is more influenced by Fed policy. That 2-year yield now up about 13 basis points to 147, the 10-year up 7.5 basis points to 180. And of course, in terms of the geopolitical situation that Powell was talking about, the uncertainty it provides or does not provide, lack of clarity to the economic outlook, but it definitely is doing something to the oil markets today. WTI crude up 4.6%. 108 is where we trade after it actually was around 112 earlier on. That is something that the Fed, of course, is watching in terms of the inflation picture. So let's get back to Chairman Jerome Powell.
The committee is too high, and the committee is committed to using our tools to bring it back down to levels of price stability, which is to say 2% inflation. So, but I would also say that given the current situation, we need to move carefully, and we will. And we'll be nimble. We'll be looking at the situation as it evolves. And again, we will use our tools to add to financial stability, not to create uncertainty. And
at this point in time, you don't think that it significantly alters your expectations for the rate increases that you've discussed this year?
I don't think that's knowable yet. I mean, so we've run, what we like to do is run alternative scenarios, and we've done some of that, as you would expect. And it's easy to find cases where it would affect, but we don't know that yet. We honestly don't, and we'll see.
Thank you. Chair Powell, could you explain the role of the Federal Reserve in implementing U.S. sanctions on Russia? How you're working with OFAC, how this actually is implemented?
Right. So sanctions are really designed by the administration. They're part of what the elected government does, where we provide technical support. We implement those sanctions, or we make sure that the banks obey them, that we supervise and regulate. That's one thing that we do. we also consult on, we have knowledge about financial markets and financial institutions, so we're providing technical support, but we're not the decision makers on those things. And honestly, these are decisions that are made at the level of the government, not at the level of the elected government, not at the level of the Fed.
And I know things are happening quickly and in real time here, but what actions has the Fed taken to date since the invasion of Ukraine?
Well, I'd say, first of all, since late last year, we've been on very high alert for cyber attacks. We haven't seen any notable incidents about that yet. We consult. We're making sure that the banks we regulate and supervise are also on high alert. We communicate with the reserve banks where there's a lot of expertise in these areas and other parts of the government. So that's one thing that we've done. As I mentioned, we are in very close contact with the Treasury Department, as you would expect, between every central bank and every finance ministry around the world. But again, we're not the ones who design the sanctions.
Right. Well, cybersecurity is certainly, this committee is, and especially at the Fed, is a top priority. I'm glad that you're watching it closely. Chair Powell, does our U.S. financial system have the necessary capital and liquidity to handle any economic fallout from this war? What kind of data will we be seeing?
I mean, the evidence to me strongly suggests that the answer to that is yes. We just went through a rather enormous shock with the pandemic and the near closure of the global economy, and U.S. banks' capital levels are at multi-decade highs, liquidity levels the same. It's hard for me to look at that and say that a lack of capital is a threat at this point. There are certainly issues. Cyber for private financial institutions is a huge issue, and one that they spend a great deal of time on, as do we.
In 2015, the Obama administration blocked the development of the Keystone XL pipeline, a decision reversed by the Trump administration, and President Biden canceled the permits, again, depriving the U.S. of over 800,000 barrels of oil a day. Wouldn't expanding the supply of oil by 800,000 barrels a day reduce energy inflation and lower prices at the gas pump?
We're not responsible for energy policy. That's a matter for Congress and the administration. Of course, the laws of supply and demand do work.
Laws of supply and demand do work. I've used my time and I yield back.
Gentleman from Guam, Mr. San Nicolas, is now recognized for 5 minutes.
Thank you so much, Madam Chair. Good morning, Chair Powell. And I'd like to first recognize one of my senators from all the way from Guam, Senator James Moylan. Thank you so much for making time to join us here today, Senator. Mr. Chairman, over the course of the uptick of inflation in the last year, you testified before the committee on multiple occasions that the Fed believed that the inflation that the country was experiencing was transitory. And since that time, especially today, there's a seeming change in that tenor. Could you elaborate more on that?
Sure, I'd be glad to. So I think very widely among macroeconomists and other central banks around the world, we looked at it as akin to an energy shock and a supply side shock. And the textbook on monetary policy would have you look through that, because the supply shock comes and goes, and by the time monetary policy is having its effect, which happens with long and variable lags, we think, the supply shock is already gone. So we looked at it that way, and I think we expected to get relief, particularly going into last fall, I would say. We expected when schools reopened, vaccinations, raised, kids back in school, we expected supply of labor to come in, that kind of thing. And it didn't happen. But it didn't happen because the supply side constraints didn't ease. They didn't ease. And so it's not like, as a practical matter, what was wrong was not the theory. It was just, in reality, the supply side constraints have been much, much more durable and persistent than we had expected. So we knew that we could be wrong, and I think I always thought we could pivot pretty quickly and catch up. And we did pivot when we started to pivot in the middle of last year, and then pivoted hard at the end of the year. But in the meantime, the economy was really healing incredibly quickly over the second half of last year. Record job growth and record decline in unemployment, record tightening in the labor market. So You know, we know that what our job is now, which is to move away from these highly accommodative settings to more appropriate settings given the very hot nature of the labor market and the level of inflation.
There's chatter, Mr. Chairman, public chatter, that the intensity of the inflation that we're dealing with today is a reflection of the Fed not taking policy action soon enough, not taking enough policy action. And there's chatter, public chatter, that causes the Fed's credibility to come into question as to whether or not it is acting responsibly and appropriately with the data sets that are coming in. And I bring this up, Mr. Chairman, because we have a duty to the American people to be able to raise these questions as pointed as they are, and to give individuals such as yourself an opportunity to really speak to the credibility question that's really out there in the community. If you could elaborate further on that.
Sure. It's for others to judge many of the things you mentioned, and we understand that. But so we, starting in December, at our December meeting, we began talking about significantly more rate increases. The market took us very much at our word, and as this year has gone on, the market has you know, so market participants do appear to be reacting, you know, what I would call as appropriately to our assessment, our ongoing assessment and reassessment of what's appropriate. And you know, I'll just assure you and everyone that we are committed to achieving price stability. We will use our tools to achieve price stability. Really, that is an essential bedrock element of everything else we want to achieve in the economy, including a strong labor market.
When we faced a financial crisis in 2008, a lot of lessons were learned about the need for the Fed to be more responsive to the liquidity traps that could take us by surprise. Given the circumstances we're dealing with today and the frustrations that the American people are facing, can you share with us any lessons that the Fed has learned with respect to its responsiveness to the inflation that we've been dealing with over the past 12 to 18 months and the intense inflation that we're dealing with today?
So the inflation that we're experiencing is just nothing like anything we've experienced in decades. It's higher, of course, much higher than anything we've seen since I was much younger. But not only that, it's different. You know, it's coming from the goods sector. The goods sector has been a source of disinflation for a quarter of a century because so many goods, so many manufactured goods have been
But just specifically, Mr. Chairman, reclaiming my time, what specific lessons has the Fed learned from the outcome that we're dealing with today?
Well, I mean, we're still living through it. So the main focus we have is not on doing a retrospective. It's on conducting policy appropriately to return us to price stability while also sustaining the expansion.
The gentleman's time has expired. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, thank you for being here, and congratulations on your nomination to continue your job for a second term. I think it's well deserved. Before I get to my questions, though, I want to hold up something here. This is a Ukrainian dollar. It's a hryvnia. I kept some of these when I was in Ukraine several years ago doing some ministry work, and I think it's interesting to think that what happens in the next few days may determine whether this is another defunct piece of currency and the nation returns to a ruble, or will this maintain some of its value. But as you look at it, you can see it's a fraction, physically a fraction the size of the U.S. dollar. It takes about 30 of these hryvnias to match a U.S. dollar, but when you look at values, our dollar has decreased in value, as you have mentioned, due to inflation. Now, a year ago when you testified before this committee, I asked what your outlook was for the economy, and you said you expected economic growth to be strong for the rest of 2021. But at that time, I warned that the $2 trillion stimulus bill that was making its way through Congress at that time was unnecessary and far too big, given the economy was already recovering. Lo and behold, these predictions came true. In your opening statement, you mentioned that you didn't expect inflation to continue at the rate it is right now, but I also recall throughout 2021 we heard that inflation was slight, it was going to be temporary, but I also understand that that prediction probably didn't include the actions and the roles that Congress had, as you had said. Now, According to a report from the Federal Reserve Bank of San Francisco, because the American Rescue Plan was so extremely large and was passed when the economy was already recovering, this was a significant contributing factor to inflation. Do you agree with that report from San Francisco's bank that our reckless spending is a contributing factor to our inflation?
I really wouldn't like to comment on any particular law, but I'll say this. All of the things that we did after the pandemic were we turned our dials as hard as we could, so did you, with the CARES Act, and the economy did benefit from that. We have the strongest economy in the world now. But part of that, no doubt part of what we did and what Congress did without naming any particular laws is also part of the reason why inflation is high now.
Right. So there are multiple contributing factors to that, being the reckless spending, which devalues our dollar, is one of those. And what we heard last night was that there is not going to be a change in the direction this Congress is going or the White House. It sounds like we're just going to repeat the same mistakes we made in 2021. Now, I know that you have the tools of adjusting the interest rate. You mentioned increasing 25 base points, and you mentioned that it may be necessary to go higher. Understand that. Do you still think that inflation will be temporary? And I believe that you said it would be short-lived going forward because of resolving our supply chain issues. But since there are other contributing factors to that, are you anticipating that Congress or the administration will undo some of the failed policies, such as the spending policies and the suppressing of America's energy supply, which has been a significant contributing factor? Let me rephrase that. If Congress and the White House does not change the policies of 2021 and continues down that same path, do you still believe that inflation will stabilize? Price stabilization will come this year?
Well, first, we've had this expectation, as you all know, for more than a year, and it hasn't actually come true. So we're humble about the fact that we can't really call with any confidence the turn, but it does seem that this year we'll be withdrawing policy accommodation. Actually, a lot of the fiscal policy spending has happened now, and so the impetus to growth will be declining and, in fact, negative from fiscal policy as it stands now. And those are things, and just the natural improvement of supply chains and labor supply and things like that. Those are the things we're looking to for relief on inflation, hoping for. Very difficult to say when they'll happen, and our job is to achieve price stability one way or the other.
Okay. I see I'm running out of time. I've got several other questions, but I'll submit those for the record. Now yield back, Madam Chair.
Thank you. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member, for this hearing, and thank you to Chair Pro Tempore Powell for joining us. It's been a challenging year. Rising prices at the gas pump and the supermarket cause real distress to working class families like my neighbors in Chicagoland, and improvements in employment and wages are real, but not nearly enough. My constituents saw a decade of stagnation after the last recession. Working class Latinos and immigrants like my neighbors are always hard hit. We simply can't afford that again. Chair Powell, you've said that inflation has been driven by bottlenecks in the supply chain, and last night President Biden highlighted their role in corporate concentration and price increases. I'll note that CEOs from Kimberly-Clark to Tyson Foods have bragged to investors about their power to raise prices without facing competition. And last night, President Biden said, and I quote, "Lower your costs, not your wages." And my constituents were glad to hear that. So, Chairman, can you explain how raising interest rates will lower prices for diapers or chicken? Last time it was because my neighbors lost their jobs and couldn't find diapers or chicken. So is that the idea?
Well, the idea is that right now the federal funds rate is still set close to zero, and that is a very stimulative level. I think it's 8 basis points today. That is not an appropriate level, we think, going forward. We think it's appropriate that we engage in a series of rate increases over the course of this year and also let our balance sheet shrink. And so what will happen then over time is demand will moderate as interest rates get into the economy over time, and these annual price increases in everything where prices are going up will moderate as well. That is how it has always worked with interest rates. We don't do competition policy, so I can't really comment on that part of it. But I will say that that's how we think about inflation, and that's how we use our tools to get inflation under control.
Changing gears, we discussed corporate concentration, and last July, the president issued an executive order on competition that encouraged the Fed and other regulators to increase scrutiny of bank mergers. It's been a long time since regulators blocked a bank merger, even an acquisition by a globally systemically important bank, or GSIB, in 2020. Chairman Powell, do you think it's appropriate to issue a moratorium on pending mergers while the Fed updates its framework for their review?
Well, I think we have a statute that Congress has passed that gives us the rules for evaluating potential acquisitions and mergers by banks. I think we have a widely developed framework for that work, and we're continuing to implement that. I mean, any changes that would come would either come through legislation or through new personnel at the Fed, neither of which we have right now.
As we learned from Wells Fargo, frontline bank workers are an important resource for regulators. They see firsthand how banks implement or ignore internal controls, and they can identify problems as they develop. Incorporating frontline workers' voices in our banking regulatory system would improve the information we have and diversify the voices that get heard. Chairman Powell, will the Fed commit to adding bank workers to your various advisory councils? Why or why not?
Very interesting question. We do have quite a diverse group of people on our various advisory councils, including people who are representatives of workers. I don't know that I don't know that we have ones that work councils, outside councils that advise us on bank supervision per se. But we do always seek out in all of our reserve bank boards and also the advisory councils that we do have representation from labor and also from people who live and work in and represent the interests of pardon me, low and moderate income communities.
Thank you. Appreciate it if you would consider that. And Madam Chair, I yield back.
Thank you. The gentleman from Tennessee, Mr. Kostock, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chair Powell, for attending this morning. If you can, a lot of times we look for historical references when we try to reference an event, a current event. A number of people, a number of pundits, when they look at inflation today, they reference it back historically to the late 70s and the early 1980s. From your perspective, is that the proper historical reference to what we're experiencing today as it relates to inflation?
That's the proper historical reference for what we're trying not to replicate. So we look back. Obviously, all of us have looked carefully at the history of post-World War II inflation and business cycles and all that kind of thing. One of the things that's different now is that central banks, including the Fed, are very squarely take responsibility for inflation. That was actually not the case in the 1970s. There was a school of thought that really there were certain things that an independent agency just couldn't do because it was too hard and Congress should do it. So now I think central banks around the world have an inflation target. They have transparency so that they can be held to account for it. You know, we're not waiting. We are using our tools now and that's really different than it was in the 1970s. So also inflation expectations have been anchored for a long time. They really weren't then. They were allowed to become unanchored without much of a response. That would not happen in today's world and will not happen.
A few weeks ago when the CPI number came out, I was on my way to a breakfast meeting in Jackson, Tennessee, where I represented one of my constituents and I, when we were talking about the new CPI number, he said, I don't care what the number is, because I know that I'm paying 50% more in gas than I did 12 and 18 months ago. I know I'm paying 20 to 25% more in grocery prices than I did a year ago. I know what the price of a new car and a used car is. If you were me, if you were a member of Congress, what would you tell your constituents about the rising cost, the expensive cost to just live today?
Inflation is too high. We understand that, and we're working on it. It's going to take some time, but we're going to get it back under control. By the way, we're seeing this everywhere in the world. We're seeing it more in the United States because our economy is stronger, but we're seeing it everywhere in the world.
Let me, if I can, follow up on a few questions.
You've been listening to Fed Chair Jay Powell's testimony before the House Financial Services Committee. We'll be back there in just a moment. But financial market action is certainly worth paying attention to at the moment. We've got big moves once again in a number of different asset classes. We're starting to count you down towards the European close, European equities, as we approach that close, trading stock 600, 446, up by around 0.8%. But I think the action really, again, a bit like yesterday, but almost kind of mirror image of yesterday, is in what is happening in the bond market and in the commodity markets. So the UK 2-year today is up. This is yield up 26 basis points. Yesterday down aggressively. Today we're almost completely reversing that. Inflation data out of the Eurozone once again indicating that we do have an inflation problem. How will central banks manage and deal with that? We've just heard from Jay Powell talking about 25 rather than 50, but you can't take 50 off the table. So an almost mirror image in the bond market of the action we saw yesterday. The story remains very much in what is happening with commodities, particularly energy commodities, but also elsewhere. This is European gas futures. We're up by 35% today. As the market really frets over the possibility of gas to Europe being cut off. If that were to happen, say Nord Stream 1 being cut off, you would potentially see, as we were hearing a little bit earlier on, a recession in Europe. That would be certainly something that you would really want to worry about. So equities are higher. Bond markets are selling off aggressively. Commodity markets, Kaylee, really once again surging higher.
Yep, and I am looking at the exact same picture here in the U.S., Guy. We are looking at equities just off of session highs at the moment. The S&P 500 up about 0.9%. The market may be taking a bit of a breath here as it gets some clarity from Chairman Powell about what exactly the Fed's move in March is going to look like. Yes, they're probably going to hike. Chairman Powell basically confirmed that, but he favors a 25 basis point hike. As for how that is reflecting in particular in the bond market, really at the short end of the curve is where we're seeing most of the movement. The 2-year yield now up almost 17 basis points. We are back north of 150, and in the commodity complex, which you were referring to, Guy, crude is off of session highs, still up 3% when it comes to WTI. 106.61 is where we trade. I just wanted to point out, too, that in addition to the monetary policy conversations we were having, we still are keeping an eye on geopolitics. The Van Eck Russia ETF is down another 3.6% today, so it is well off the lows, but this is after a 24% drop yesterday, a 30% drop Monday. Just a good way to gauge how Russian assets are doing, considering that the MOEX is still closed for trading. But let's get back to the macroeconomic picture and at least the monetary policy picture here in the U.S. Fed Chair Jay Powell is continuing his testimony before the House Financial Services Committee. Let's take a listen.
5 minutes.
Please. Thank you. Thank you very much, Chair Lady Waters, for your leadership in calling this hearing. Mr. Powell, first I want to say that at a time when we are still recovering economically from the COVID pandemic and we're facing challenges at home and now in Ukraine, I think and I feel deeply that the Fed should not be subjected to political stunts in the Senate with boycotts by the Republicans, and the Senate should consider the pending Fed board nominations as soon as possible. The Fed has an important job to do, and President Biden has put forward qualified nominees, and we need to get this done. So that's just my main point. With that said, as you and I have discussed in the past, the economic recovery has not been even, and we still have a ways to go to ensure our economy works for everyone. Just as one example, the black unemployment rate remains at nearly 7%, which is more than double the white unemployment rate. And later today, the Select Subcommittee on Corona Crisis is having a hearing where we will be looking at the depth of the pandemic's impacts on child care providers and workers and the results that has on our families and our economies. So I want to ask you about the monetary policy report the Fed released on Friday. The Fed notes that the labor force participation rate remains well below estimates of its longer run trend as a result of retirement and people out of the labor force and engaged in caregiving activities. From both a macro perspective and a micro perspective, what does this drop in labor force participation mean for the U.S. economy, and what does it mean for those workers who leave the workforce to care for their children or family members?
Well, having a lower labor force participation rate now, it's about a little more than a percentage point lower than it was. It reflects a lot of retirements. And, you know, what it means is that our labor force is smaller. That has consequences, including it's contributing to the labor shortage that we're seeing across industries all across the country. If we had a few more million people working, then we wouldn't be feeling that quite so much. It also means the potential output of the country is lower. Many of the people who are not in the labor force are retirees who have made a choice, but some of them are still people who want to come back but perhaps can't because of child care activities or fear of COVID or other factors. In any case, it's been the decline in labor force participation that we've seen has been much larger than that of other comparable nations. And it was not something we expected, and it's certainly something that's now contributing to wage inflation and actual inflation and to the labor shortage that we're currently seeing.
Oh, thank you. It's been announced as a result of the Ukraine war and other disagreements that Russia and China are now moving to trade completely in their currency, no longer using the dollar. And Pakistan has flown in to meet with Russia. There's some talk that they may be part of it. What effect would that have on the U.S. economy if China and Russia no longer use the dollar in certain block trades around the world and with each other? What effect, if any, would it have on our economy?
Well, we do benefit from being the reserve currency for the main reserve currency for the world, and that really is because we have open capital accounts and the rule of law, and we have inflation, you know, over a long period of time under control, so that the dollar preserves its value. And so our markets are the most liquid, and it's the place where people want to be. Over time, the question is, if some want to move away from the dollar, what will be the effect on us? I don't think it's something you would feel right away. Over time, they would have to create an ecosystem, economic ecosystem, whereby another currency becomes, you know, a better currency for them to use. You know, what we can do is we can make the dollar the most attractive currency by continuing to have the rule of law and open capital accounts and make it an attractive place for people to invest and to use in their businesses. There wouldn't be any short-term effect of that. Over time, though, you know, it would I suppose it would diminish our status as the reserve currency. It's also possible to have more than one large reserve currency, and there have been times when that was the case, and so it's not really clear.
Thank you. My time has expired. Thank you. You're back, Madam Chair. Thank you.
Thank you. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair, and to continue several points that a number of my colleagues have raised. As Putin's aggression in Ukraine has continued to escalate, U.S. and its allies have responded in a unified voice to condemn Russia and apply economic pressure. Chairman Powell, could you discuss the difficulty of predicting what the implications will be of locking Russia out of SWIFT?
So again, on sanctions, we're not the right folks to ask. We don't design them. We don't implement them. So it would be really a question for the administration.
Let me word it this way. How sweeping do you foresee the ripple effects through the U.S. financial system? Is there an effect on us as those actions take place?
With big actions like this, there may well be unintended and unexpected effects, and hard to say what those might be. In the economic sphere, you're seeing, not directly to your question, but we're seeing concerns over palladium and neon and corn and wheat, shortages of those potentially, but. So it would be difficult to say exactly what the effects could be over time. The United States, our financial institutions and our economy do not have large interactions with the Russian economy. It's a relatively small thing, and it's gotten smaller and smaller in recent years. So there wouldn't be direct effects from these kind of things on the U.S. economy. It's hard to think what the second order effects might be.
Thank you. You've answered my question. As Congresswoman Wagner touched on, the price of oil has continued to climb during the past year to its highest level in more than 7 years. And we now see international banks appropriately shunning Russian oil, even without energy sanctions. Can you describe the range of different scenarios the Fed projections paint in regard to this? And along with that, how do you see this potentially impacting the already rampant inflation issues?
Well, obviously the price of oil depends on events that haven't occurred yet. It really depends on where this goes going forward. We have seen prices move up, including just in the last couple of days, and they moved up quite substantially since, if you go back 3 months before this incident kind of began, prices are up quite a bit. The effects are going to be passed through into gas prices, into lower economic activity, and into inflation, headline inflation. And the larger the increase, the larger the effect. But the question then will become, that's a price level change. Is that going to lead to repeated inflation increases at that time? And that is not necessarily the case. And of course, we would use our tools to make sure that it's not the case.
And of course, representing the constituency I do, which is both oil and gas and production agriculture, we take very careful note of what those actions will affect, how they will affect world crude oil prices. And of course, the Ukraine being a very historic major grain producer, my wheat people also are prepared to step up and match that. But it all underscores, I suppose, the increased energy production in the United States and supporting policies that will not penalize or drive capital away from domestic oil and gas production. That's more of an editorial on my part, Mr. Chairman, but I note that we stand ready in this country to replace resources that may not be available or affordable for the rest of the world, and we just need a little incentive and encouragement from this side of the room to utilize those things. So my last question in the time I have remaining, the economy is currently operating in what I think we'd all describe as, at the very least, massive economic uncertainty. And when you deal with this 40-year inflation, supply chain issues, and the COVID-related issues, hopefully as we're in that final stage, can you elaborate on how critical it is for the health of the economic system to be reliable and to maintain liquid markets so we can navigate through all of whatever lies ahead of us?
Yes, so I would say our markets have been functioning well. There's a great deal of liquidity out there. We have now, between our swap lines and our repo facility for other foreign central banks and our standing repo facility in the Treasury market, we have institutionalized liquidity provision, and I think just the knowledge that that is there will help support good market function, which, despite all this volatility, we still have.
Thank you, Mr. Chairman. I yield back, Madam Chair.
Thank you. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman Warder. Chairman Powell, thank you for being here today. Given what you said about the upcoming meeting in March, and the illegal invasion of Ukraine, how is the Fed coordinating with other central banks around the world and accounting for their actions when considering adjustment to interest rate policy here at home?
So we're in ongoing contact, it's fair to say, with our major central bank colleagues, and actually we have a meeting of all of them on Monday morning at 7, a virtual meeting at 7 a.m. on Monday. So it's something that we do regularly. That said, we conduct monetary policy to achieve domestic objectives, specifically here in the United States, maximum employment and price stability, and that's what we use our tools for. But it's of course the foreign events are very much top of mind right now, and it's enormously helpful to understand the perspectives, particularly of the Europeans who are so much closer physically to what's going on. So that's an important channel for us.
Thank you. And Chair Powell, last week the Fed published its 2022 Small Business Credit Survey. Among other things, the report found that small business applicants that used online lenders for their financing needs reported more challenges with their lenders than did applicants at other sources. The top challenges faced by borrowers from online lenders were high interest rates and unfavorable repayment terms. Can you explain the report's finding and what it could mean for small businesses that utilize online lenders to satisfy their financing needs?
So if I recall that survey, it did raise some interesting questions, and our people looked at it and actually saw differences in data gathering. So it's not clear that the data in the two surveys was comparable, but I do think it raises interesting questions, and we'll come back to your office on that.
And it might raise interesting question where we, through legislation, could provide some relief and regulations so that small businesses are not shortchanged when it comes to the most important element for any small business, access to capital, affordable capital. Chair Powell, during public remarks last month, acting comptroller of the currency, Sue, stated that in the not too distant future, the OCC, Fed, and the FDIC will issue a joint notice of proposed rulemaking to update the Community Reinvestment Act. Does the Fed also believe a joint NPR is possible, and when do you expect it to be released?
Yes, we do. We think that will be ideal, and we're working very closely with the OCC and the FDIC and to come up with a consensus notice of proposed rulemaking reflecting all of the comments that we got on our advance notice of proposed rulemaking. I think the timing is soon. I wouldn't want to put a specific date, but I know that we're going back and forth, and it feels like we're getting very close.
Right, thank you. And Chair Powell, a note published by a Credit Suisse strategist over the weekend warns that a decision to exclude certain Russian banks from the SWIFT system, which I support, could result in missed payments and giant overdraft with significant consequences for money markets, thereby forcing the Fed and other central banks to intervene to enhance liquidity to offset missed payments. Do you see this scenario as likely?
No, I don't see that as likely. Of course, we always appreciate looking at different risk scenarios, but again, given the relatively modest exposure that our banks have directly to Russia, and given the existing tools we have to provide liquidity, I don't see that as a likely outcome.
Okay, thank you. I yield back.
Thank you. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Madam Chairman, thank you very much. Chairman Powell, thank you for taking time to not only join us today, but your insight into monetary policy. The Monetary Policy Report of February 25th, seemingly still hot off the press, brings about, I think, a good review of the Fed's analysis of where we are. And I know there's that temptation by members of Congress to hold you accountable for things which are not within your purview, but on page 3, you talk about special topics. Page 3 of your February 25th, 2022 monetary report. Special topics, low labor supply. Next, it goes to several other issues, then supply bottlenecks. As a member of Congress from Texas, both of these are highlighted to me on a daily basis as I receive feedback. This is inflationary also. We have taken a bit of time with you to probe with you your ideas that I think you have professionally handled on behalf of yourself and the Fed, the issues related to energy. But the bottom line is we can't get people back at work. We find that turns into a low labor supply, and then we've got bottlenecks. These are all hand in hand, glove in glove together, in my opinion. I took a few minutes just now to look at the labor unions and schools, teachers unions. But let's move to the federal government. Where is the federal government on their employees coming back to work now by OPM?
I don't know. We're an independent agency. I'll tell you where we are, which was we're in the middle of that process. Probably closer to the beginning than the middle.
I know you are, but you see, if they don't come to work, then others don't come to work. So I think your point and my point is well made. I believe that what we need is your robustness, not just your acumen in these issues, and your robustness within the administration to actually let them know that for this report monetary policy to be correct, that you believe inflation is a short-term, meaningful hindrance on our economy. They're going to have to make, meaning the White House, policy. They're going to have to understand what caused this. And I think that this administration, I think the Democratic Party, I think this Congress has made friends with inflation to encourage it. And that if your prognostication is going to come forth that we end this inflation, we're going to have serious changes. Because right now in Texas, which has been relatively open, I don't see relief on the horizon. And I think that this administration, this Congress has a lot to do with it. So without chastising you, I meant to help you. I would like for your voice in this administration and within the halls of Congress, perhaps doors that are shut, for them to understand that they have actually made friends with and are continuing inflation, whether it be with teachers unions or whether it be with OPM. And we've got to get serious about getting people back to work, because as you tap down the amount of money that is put in the economy, as that moves, it's going to have to correspondingly have people that come to work, that pay taxes, that move the economy, GDP as a term we used earlier today. It's shifting this big, massive task. So you've almost got a whole 30 seconds left. But I'd like you, without defending yourself, to say to you, I'd like for your voice of reason, of prosperity, of future to come true as you would like. Did I ask you a question? Okay, I'm going to support you. I'm for you. How can we help you?
I do think honestly, we have the tools and we have to use them we will use them to get inflation under control. But to the extent we get help from the supply side, it'll make that job so much easier. It's about labor force supply. It's really about supply constraints and shortages and that kind of thing. It's also about exogenous events like a war, which will drive up the price of oil and gas, and that'll get into into prices, certainly, and we'll make sure that it doesn't provoke a cycle of inflation.
This is what happens when you have to rely on other people for your food, cheese, and energy. Thank you very much, Mr. Chairman.
Thank you, Mr. Sessions. You can help Mr. Powell by asking your friends on the Senate side to confirm his appointment. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agriculture Committee, is now recognized for 5 minutes.
Chairman Powell, how are you?
Fine, thank you. How are you, Mr. Scott?
I want to sound the alarm here this morning, and I want you to listen to me, and I want the nation to, because I'm the chairman of our House Agriculture Committee, and I'm very worried about this turmoil over in Ukraine